Good afternoon, everyone. Thank you so much for joining our panel today, which focuses on understanding the European Union Sustainable Finance Disclosure Regulation, or also known as SFDR. My name is Elena Filipova. I'm Director of Sustainable Finance and Investing at the London Stock Exchange Group. And I have the great pleasure to be sharing this virtual stage today with two amazing leaders in the space. Eric from Nordea, joining us today from Copenhagen, and Bashak from TT International, joining us from London. Before I ask our panelists to introduce themselves, please allow me to briefly set the scene. The European Union Action Plan on Sustainable Finance, which was published in 2018, is one of the most comprehensive and ambitious regulation around sustainable finance to date globally. And it also allows and aims to create an environment that facilitates, that enables the shift towards sustainable and low carbon economy. What's important to flag is that there are no trade-offs between incentivizing a speedy recovery of the economy, the delivery of financial growth, and also the support to a sustainable transition. Actually, on the contrary, the sustainability transition is a source of economic growth and job creation. A more sustainable financial system means that the economies, the society at large, is more resilient towards volatility and disruptions. And we should remind ourselves that we are in a century of significant shocks and transformations. So the resilience towards disruptions and change should be central to any business, any global participants and governments. And actually the same holds true for businesses. Companies that manage well their environmental and social impacts and performance also deliver stronger investment returns and are more attractive to sustainable investors and financing solutions, which is continuing to grow at phenomenal rates. So let me now bring in the panelists. And can I please ask you to introduce yourself, starting with you, Bashak, and also if you can provide brief perspective on today's topic.
Of course. Thank you, Elena. And thank you, TÜYİD, for having me here as a speaker. My name is Bashak Yeltekin. I am head of ESG at TT International. We are a global asset manager, and we have around $10 billion in assets under management that's invested in both long-only products and also alternative investments, so more hedge fund strategies. And our flagship strategy is a dedicated global emerging markets equity fund, and around 8% of our assets are invested in emerging markets. So we are a dedicated EM investor. I joined TT in 2020, and I'm responsible for ESG integration and also ESG reporting. Prior to joining TT, I worked for 6 years at the Norwegian Sovereign Wealth Fund, where I was responsible for all aspects of ESG, starting with ESG risk management and continuing with ESG integration, and finally working on company engagement and voting. So I have worked on all these different aspects of ESG, which was quite an interesting and well-rounded experience. And prior to the Norwegian fund, I was at the Harvard Management Company. This is Harvard University's endowment in the US, where I was a portfolio manager, and I invested in emerging markets, including in the Turkish equity market. And in terms of our perspective on SFDR, we think it's a very important, a seminal piece of regulation for the asset management industry. We see significant interest from our investors, especially European investors, in investing in ESG products. These are the Article 8 and 9 products. as we will discuss more later. And we ourselves have launched a highly successful environmental solutions strategy that recently won the Global Thematic Fund of the Year award. And in this strategy, we look for companies in global markets that deal with climate change, that try to create solutions towards tackling climate change and also environmental degradation. This is an Article 9 fund, for instance, as defined by the SFDR, which is the dark green product. And at the moment, we are working on 2 Article 8 funds. These are more broad ESG funds. And ESG product development requires us to understand what SFDR is, apply it in our product development, and also seek to define, for instance, what is positive contribution towards environmental and social issues. And my role is to define these strategies along with our investment and marketing teams. And therefore, SFDR is extremely important for us as we are working on both the product development and also reporting.
Thank you so much. Impressive background, and thank you for joining us to share your experience and expertise. Eric?
Yes, thanks for having me here. It's always nice to be able to spread the gospel around the ESG and around SFDR, which is super important for all of us. Also us at Nordea. So Nordea, the company that I work for, is Nordic asset manager based in Copenhagen and Stockholm primarily. We manage just under 300 billion euros in total, of which around 2/3 is in Article 8 or 9 products. So that's the ESG part of the product range. And then we have 1/3 which is still in Article 6, which are the products that don't take sustainability issues into account as much, because according to the regulation, you still have to, even in the 6, you have to take into account the ESG risk, which is financially material. So in the 8s and 9s, we talk about sustainability risk, which is not necessarily financially material in the short to medium term, but more material for the environmental and social aspects of society. We run, as I said, 2/3 of our AUM more or less in Article 8 and 9 products. One of our flagship products is our climate and environment strategy, which we launched back in 2008. So we have a long history with this. That fund is currently the largest Article 9 product in the EU and therefore also globally. And to back that, I have a team of just under 30 ESG professionals that work with me. It was a team that was founded back in 2009 with 4 or 5 people. It has grown steadily over time. When I took it over 2.5 years ago, it was about half the size it is today, and it just keeps growing. And it's to tell you that this regulation and the demands that it puts on us in terms of disclosure, in terms of data that we have to gather from companies to make sure that we do things the right way. It's just growing and growing, and it's very, very labor intensive. And I expect that in the audience we have many companies that are thinking about how will this hit me? Well, the first way it will hit you is that the data that we and other asset managers will ask you for in order to be able to comply with the rules that we have to follow. You will have to make that available. I think we'll come back to that.
Thank you, Eric, as well for joining us today. We know that consumers and investors play a critical role in the growing considerations around ESG and sustainability. And I would like to describe this as the push factor towards ESG, towards transparency and transitioning. But there is the very important pull factor from regulators and policymakers that are reshaping the landscape in terms of setting public policy targets and goals and objectives with very significant implications on the private sector. So Eric, maybe I can start this conversation with you and ask you the first question, which is around the sustainable finance regulatory landscape. How do you see it changing and shaping across the European Union? and what, from your perspective, has the greatest impact on the audience today?
Yeah, I think that the greatest impact comes from the fact that another piece of regulation, which is not the topic today, but which plays together with SFDR, namely the MiFID regulation, which will be updated as a regulation that applies to financial advisors in the EU. That will, from August this year, mean that every financial advisor, every bank who wants to sell an investment product to a client will have to ask that client how that client feels about sustainability. The client can then give a picture of do they have any sustainability interest? If they have, what is it? Is it climate? Is it gender diversity? Is it social issues? And then the asset manager and the investment advisor will have to take those into account. So the advisor, the bank that sits with this client, they will have to have products on the shelf that can cover this need. I, as an asset manager, and Bashak will have to deliver products that can cover that need. And in order to be able to document that these products actually do what we say, we need information from the companies in which we invest. So that's the huge effect of this, that the demand, not just because we think it's fun and we'd like to know, but really in order for us to be able to brand these products the way we want, the demand for data, for information from companies is just getting that much bigger. And in about 2 more years, we will have new EU regulation, which will actually mandate companies to deliver this. That's the CSRD, the Corporate Sustainability Reporting Directive. It's not in force yet, but already we are asking for this information. Already the data providers that we use are asking, we are asking, and whether you are an EU-based company, which is in principle what this should cover, or you are a company outside of the EU, in Turkey or anywhere else in the world, these questions will come either in the form of questionnaires or in the form of calls to your investor relations departments, or request that you build out your annual and your quarterly reporting with information related to these issues. Because if you don't report to us, then we cannot report to the client, and if we cannot report to the client, then we cannot sell to those clients who say that this is important for them. I think that's in a nutshell really what this is, how this implicates all of us in the value chain here. Or what do you think, Bashak? Do you agree?
Very helpful.
I do.
Thank you, Eric, for setting the scene as to why the demand for ESG sustainability data from companies is exponentially growing, and it's impacting every corporate union. But zooming into the topic of our panel, which is SFDR, Bashak, maybe I'll direct now the conversation to you and ask you to help us make sense out of the regulation. What is it actually? Why do we have it? What it's aiming to achieve, and when? What is the timeline around it that we all need to keep in mind?
Sure. I would like to share some slides on this topic, and hopefully they will be of interest to the attendees. So what is SFDR? SFDR is part of the EU action on sustainable finance. This has been in movement since 2018, and it is focused on capturing sustainability risks. So the focus is really on risk, and it imposes mandatory ESG disclosure obligations for asset managers. As Eric said earlier, it applies to all asset managers, even those who don't express an ESG preference. And the objectives are to provide our investors with greater insights into sustainability risks, help investors differentiate between different products, because there are a multitude of products that have all kinds of ESG focuses, and also prevent divergent national disclosures. So indeed, any investment manager that wants to market their product in the EU will need to report according to this regulation. And In terms of the SFDR, there are 3 product categories. This depends on how much sustainable and ESG considerations are taken into account in the investment policy. These are Article 6 products. These are mainstream products. There are Article 8 funds, which are the so-called ESG funds or light green funds. These are more broad in their perspective. And finally, there are Article 9 funds. These are sustainable or dark green funds. And all asset managers, as I said earlier, all asset managers are under the scope for SFDR. So it is very important. It's a seminal regulation for our industry. In terms of the Article 8 and Article 9 funds, what are these? Again, the Article 8 products promote environmental and or social characteristics. They may make sustainable investments, such as in environmental solutions, but they don't have sustainable investing as their core objective. Now, for instance, let me describe a little bit about how we approached this topic when we did the topic of positive contribution when we were looking to create an Article 8 fund. So we basically looked at the United Nations Sustainable Development Goals, and we structured our approach to positive impact around the SDGs. And we also try to exclude exposures to some sectors such as fossil fuels and tobacco that don't necessarily make a positive contribution. But when we were looking to quantify companies' positive contribution to SDGs, we of course relied on company disclosure and also data providers. And I'm mentioning this because companies really do stand to get more investments by improving their disclosure and engaging with ESG data providers. And in terms of the Article 9 products, for instance, we've been guided by the EU taxonomy, which is another piece of regulation that's been very, very important for defining what is environmentally sustainable. And we structured our investment themes around the EU taxonomy's 6 environmental goals. So these are climate change, adaptation and mitigation, sustainable use of water and marine resources, transition to a circular economy, pollution prevention, and biodiversity protection. So the regulation is very important in terms of defining the parameters for investors, and of course, determining what needs to be reported. Of course, Article 9 funds, the sustainable investment funds, they also need to make sure that the companies in the funds don't infringe on human rights, labor rights. They don't have gross corruption incidences. So this is, it requires good conduct also from the companies. Finally, the principal adverse impact indicators, I want to mention this because it's an important piece of data that we will be looking from the companies, as Eric alluded earlier as well. And as you can see, there are 14 mandatory indicators. On this slide, we are showing only the environmental indicators. You will see that 6 of the 9 environmental indicators are around climate change. And this shows how important climate change is for the EU. And it shows that we need more disclosure from the companies, especially on climate change, and target setting from the companies. There are also really, really important other topics such as biodiversity, water, and waste. We are going to be looking for more and more information on these fronts. And on the social side, social and employee matters, again, we will be looking for violations of UN Global Compact principles and the OECD guidelines for multinational enterprises. We will be looking at processes and mechanisms to monitor compliance with these principles. We will be looking at gender pay gap and board gender diversity and any exposure to controversial references. This is a very narrow part of the EM universe anyways, but these are some of the mandatory indicators that we need to be looking at. And finally, in terms of the SFDR deadlines, SFDR became effective in March 2021. As of the 1st of January 2023, we will be required to make detailed and separate product disclosures for the Article 8 and 9 products. So these are the ESG funds. Middle of next year, it is the first disclosure of the entity level principal adverse impact indicators. That's going to be very, very important for larger asset managers as well. Finally, the year after, it's going to require a PAI disclosure with a historical year-on-year comparison. This is a very short summary of what SFDR is, and hopefully it's been somewhat helpful for our audience.
Very helpful, Başak, and thank you for this great overview of the Sustainable Finance Disclosure Regulation. It can be overwhelming, and I think you summarized a lot of legal requirements and text in a great way. So thank you for doing that. What it sounds like, it is quite clear that companies should be thinking about how to be included in those products. It seems like that's where most of the attention and funding will be going. So, Eric, what is your advice to the audience today listening to us? How to make themselves more attractive for investors and actually increase the likelihood for inclusion in Article 8 and Article 9 type products?
Yeah, I think it's correct, as Başak said before, that companies make themselves more attractive the more they disclose. If you have no ESG disclosure at all, you risk that someone passes judgment on you without having really looked at you. And for some of these criteria that we have to fulfill, we can't even buy a company when there is no data. So for companies to not shut themselves out of a large part of the market, because this, as you said, this is a growing part of the asset management market and a growing part of the funds that are managed in Europe. And we know that US asset managers, UK asset managers who have Europe as part of their market, they are also starting to follow this regulation and to use these principles for their funds. So if I run a company and I don't disclose any of these parameters, then it's very, very difficult for an asset manager to buy my share or my bonds. So therefore, my advice would be to familiarize yourself with this legislation, with these different indicators, then see which ones of them are relevant for the business that you do, and then start working on how you can disclose on those. And of course, the idea that what the European Union wants to achieve with this is, of course, the moment that you start disclosing, you also start yourself thinking about, okay, what is my carbon footprint? What is my emission to water? What is my biodiversity impact if I have one? What is my board gender balance and so on? So step one, disclose. Step two, of course, improve those numbers if they are not already looking good. Because the more you follow this, the better you look, the more interested investors will be in buying your share.
All right, Başak, do you want to add anything in terms of advices to the companies?
I will largely mirror what Eric said. I would encourage companies to study, especially the principal adverse impact indicators,
yes,
indicators that we went over earlier. Do a gap analysis, and improve their disclosure and improve their conduct and improve their performance on some of these. For instance, we talked about how important climate change is. It's really important that companies disclose their emissions and also set targets to reduce these emissions, because it's going to help investors invest in them, even if they are coming from a high base. If they're ambitious, they can still qualify as investments in ESG funds. So, and I really believe that there are easy wins that can be achieved, such as increasing renewable energy purchases. This is a really, it's a no-brainer. We really see the necessity for this, especially when we see gas prices in Europe go so high. We also think that you can appoint more, the companies can appoint more women onto their boards. There are still some companies in EM and even in Europe that don't have any women on their boards. So this is a, since women are half the society, it's an obvious thing to do to be more investable, in my opinion. And also, companies should improve their supply chain due diligence, create human rights policies where these don't exist. So yes, my suggestion is to really study the regulation, the indicators, and see where you have gaps, and create policies and set targets on some of the more quantifiable metrics. And for companies that provide environmental solutions, such as renewable energy generation, or insulation, or cables for electrification, I would encourage them to study the EU taxonomy. This is a different regulation, but it's important and it's relevant for SFDR. We have started seeing EU companies disclose their taxonomy eligible revenues, OPEX and CAPEX, capital expenditure, in the first quarter of this year. We would, of course, we think that Turkish companies can also follow this approach and try to quantify their environmental solutions revenues and environmental revenues like this. And of course, we would welcome more investments into environmental solutions as we see greater onshoring benefits in the West, in Europe, especially in, for instance, things like renewable energy or better supply chains. We think that Turkey could really benefit from these trends. So we would encourage companies to make investments in these fields.
Thank you so much. Very clear and action-oriented advice given to those listening to us today. I would also add one point that companies that do not report data force data providers like us at Refinitiv and LSEC to estimate the performance of organizations. And those estimates are built leveraging the precautionary principle, which actually results in proxy data, which most of the time estimates performance above the actual performance and impact of the organizations. So I think that there is a very good reason and incentive for everyone to be transparent about their actual footprint, because most likely what's being used to fill in the gaps when you're not reporting is putting you in disadvantage and in a worse light. So just sharing that comment as well. But we've few times made the reference to the fact that sustainable finance and specifically SFDR type products are growing. But is this a trend? Is it short-term development? And I'll bring in a couple of numbers just to put things a little bit in perspective. At the end of Q1 this year, based on our analysis and data available in Lipper, we see that there are more than 37% of overall AUM held in ESG-related funds. It's 37%. That's more than a third of AUM is currently held in ESG-related funds. I think this number is really impressive and a lot higher than what we're used to seeing in the industry. And the majority of those assets were held in mutual funds and ETFs, which are aligned with Article 8 funds. So we do see actually already a lot of inflows in these new labels, so to speak. But is this trend going to continue to grow? Why? And why do you think that this must be at the forefront of corporates and their efforts? Eric, if I may turn that to you.
Yes, well, I think you only have to switch on the TV or your news site on your laptop to know why this will keep growing. I mean, the climate emergency that we are in globally shows no signs of abating. A lot of things need to be done. The EU is definitely not letting up on this. The United States has just introduced legislation, so the SEC, the Securities and Exchange Commission, has come out with rules that require companies to disclose their climate impact. This is not stopping. It's just getting more and more and more and more and more on the social side, more and more on the side of biodiversity, all these issues. For a long time, you know, if you were a company, you were able to ignore, let's put it in a nice way, the side effects of what the production that you had. So if you were emitting greenhouse gases, or you were emitting maybe chemicals to a river or to the sea, or maybe you had issues with child labor in your supply chain, that kind of thing. It wasn't really taken that seriously, but now the way the world is changing, both because consumers are getting much more aware of these issues, but also because simply in the question, when it comes to climate, countries are starting to act, legislators are starting to act, and it's simply inconceivable that this would not continue, and that is also what the EU is trying to achieve with this. So I see only one way and one trend, and that is that the demands on companies are going to get higher. They're going to need to find ways to produce with lower emissions of greenhouse gases, with more respect for human rights all the way down in their supply chains, and that's simply the new reality that we're in. So I don't see this stopping. I see it becoming more and more important. And I think, as you said, Elena, the growth of this new concept of Article 8 and 9 funds also illustrates this. That has been exponential since it came into force. Companies are launching new funds. They are changing existing funds. They are going through. And I think that with this new step that is coming now from August, where consumers will not have to say themselves whether they want something sustainable, but they will be asked directly by their financial advisor, that will accelerate it even further.
Great. Thank you. It all sounds great, but we all know when it comes to ESG data and regulation and disclosures, there are some challenges. So it's only fair to spend a couple of minutes and talk about some of the barriers, the challenges that the industry is dealing with, and provide some of your practical advice of how to overcome them. Başak, if I may start with you.
Sure. I think it's going to sound a little bit like a broken record, but again, it's the challenge is data availability for us, and we will there will be the obligation for investee companies to make the ESG data publicly available. So that is a big bottleneck, and therefore, at the risk of repeating ourselves, we do encourage all companies to improve their reporting on important ESG metrics, and also they can show more. They can show that they are more investable by disclosing these data points. And all the other the near-term challenges for us is the EU taxonomy calculations and principal adverse impact statements that are going to be coming in next year. So those are the more near-term challenges for us as asset managers.
Yeah. Eric, anything to add without repeating?
Yeah, maybe it is repeating, but it's just to say that all this disclosure, of course, the reason why this is being asked for by the legislators is that, yes, we can show it to clients. They can make their choice which company do they want to invest in, but it's also for the companies themselves to for the first time have this data. If you know, I'm sure there are many companies who have not been following what their carbon footprint is now, because investors are asking them to disclose it. They will calculate a number, they will look at it, and then as Başak said, set targets. I mean, then you know, you do yourself a favor by trying to reduce that, because it means reducing your energy use also, and that's that can be very positive for your profitability. So it's really a win-win all around. It's of course difficult, it's a nuisance, it's work, it's annoying. Oh no, why do I have to start doing this now? But once you get going with it, and once you start being able to use it internally, also I think it will benefit a lot of the businesses that we're talking about, and make them stronger and more resilient. Really making the circle back to what you said in the beginning, Elena.
That's a great point. A lot, maybe final comments, and also in terms of what's coming next, what should the audience keep an eye on in terms of the upcoming developments? Bashak, any final comments from you?
I just think that we are going to see much more scrutiny on our disclosures and what we say is sustainable and whether it is indeed sustainable. Definitely the asset managers are going to feel that scrutiny. And also there will be more pressure on ESG data providers in terms of their methodology, the transparency, their estimates. There's going to be probably more communication between not only corporates and the ESG data providers, but also investors and the ESG data providers in terms of the data quality and the estimates. So I just think that we will need to increase transparency in line with what the regulators are demanding from us.
Thank you. Eric, final comments from you?
Yeah, and that's for now, it's us as asset managers and as investors asking for this information. From 2023, it will be actually EU regulation for those companies that have subsidiaries inside of the EU. It will be the CSRD, the Corporate Sustainability Reporting Directive, that comes into force. So there's really no way to hide from this. So even if it's you think it's tedious, even if you think it's a lot of work right now, it is coming. So that's really my advice. Start looking at the indicators, as Bashak said. Start seeing which of them you can actually put some data together on. Which ones have you been watching already, if any? And then start collecting the data for the rest.
I guess I'll wrap up the conversation and try to summarize it. As Larry Fink, CEO of BlackRock, said in one of his letters, sustainable finance is the greatest business opportunity of our lifetime. But I'll add to it that it can also be the biggest risk of our lifetime if we procrastinate and delay action. Therefore, it's really important to follow on the great recommendations that both Bashak and Eric provided to everyone today. The growing demand for data is pushed on the market by sustainable finance regulation, by SFDR, but also by MiFID, EU taxonomy, and CSRD is coming very fast and impacting everyone. The biggest call for action for organizations, businesses listening today to the panel conversation is to be transparent, because data informs actions and brings in accountability and responsibility. It's been an honor learning from both of you today, and I'm sure the audience has also benefited as much from this conversation. So Eric, Bashak, thank you so much again, and have a good rest of the sessions.